Okay, good morning, everybody. This is Dan Russo, the Chief Market Strategist at Chaikin Analytics, bringing you Stock Market Today for Tuesday, August 4th, 2020. Chaikin Analytics brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. We also bring you daily stock ideas to consider upon further analysis, and that hits your inbox every trading day before the market opens. And as always, you can follow me on Twitter at Dan_Russo_CMT. U.S. equities were higher in Monday's trading, with the NASDAQ setting another record. Growth outperformed value again, with healthcare and technology leading on the day. The bond proxies lagged. Treasuries were mixed. The dollar was stronger against the major crosses. Gold finished slightly higher. WTI crude was up 1.8%. As we get to the desk this morning, futures are under a little bit of pressure to start the day, down about 20 basis points after Asian markets were mostly higher overnight. European equities are flat, a little changed in morning trade over there. Treasuries are mostly stronger with the curve flattening. Dollar is little changed versus the euro, slightly weaker against the yen. Gold is up 30 basis points. WTI crude down 1.5% after gaining nearly 2% yesterday. So that's the structure of the S&P and the structure of things as we dive in. Taking a look at the chart of the S&P, follow through to the upside. I think we had a little bit yesterday. You could call it that. I mean, I guess for now we can actually say we are now finally up and out, right? This is kind of, we're there. 3250 was the level. Tried to push through, faded. Tried to push through, faded. Finally broke up and out. Now we'll start talking about this gap. We'll move resistance up 3350 to 3400. That's moving it up from where it's been. I'm happy to do that here as the evidence supports it. To the downside, 3100 to 3200 is near-term support, 2950 to 3000 below that. So you can see how the levels shift, right? Probabilistic, based on what's happening, not a static view, right? The static view gets you in trouble. The probabilistic Bayesian view is how you win in the market, or at least put yourself in a position to win. The odds are changing every day. Something that you think yesterday morning may be totally irrelevant this morning because the shift has changed the odds, right? That's all there is to it. Simple fact of the matter. There's nothing guaranteed. There's no magic bullet. There's no secret indicator that works every time. We just update our probabilistic views every day as the information changes. Right now, our view remains to the upside. That was our probabilistic view. It's playing out. And each data point gives you a chance to reassess those odds. Small divergence still in play on the overbought, oversold here, while Chaikin money flow is bullish. So the indicators, for the most part, are confirming what we're seeing in price action. The February highs remain in play. Our base case remains the same. There's not a ton to say from the kind of S&P level, right? You know, my views under the hood is where all the action is. So that's where we focus. Let's talk about our market in a minute, though. What are we writing about in the note today to Chaikin Analytics clients? New highs for the Qs as it regains momentum. We told you it was likely to happen, and it did. We told you that the growth pullback was just position squaring, got a little bit of ahead of itself. And that thesis is playing out. Consumer sectors show signs of relative weakness here in the near term. We'll take a look. But online retail is at new highs. New world order, folks. Financials refuse to get off the mat. Futures point to a lower open today, as I said. Let's take a look at the power bars now for the major indices. Green on the screen yesterday all day as we followed through. The Dow was up 90 basis points, 9-9 bulls to bears there. So no change to the ratio for the Dow Jones Industrials. S&P 500 tax on 66 bips, 147-90 bulls to bears there. NASDAQ outperforms, 38-6 bulls to bears for our favorite of the major equity markets. Small caps, arguably my least favorite, and kind of trying my patience. Still an underperformer though it did have a good day yesterday. 612 to 287 bulls to bears there. Bonds down tick, sending yields slightly higher on the day. Information technology, our favorite sector, led the charge up 2.5%. 24-8 bulls to bears for the power bar ratio for a tech sector that just continues to drive the gains in this market. What is tech? First and foremost, it's growth. It's where the world is going. And in a slowing growth world that we've been pounding the table on for 17 months, yes, months, you want to favor what's growing. That thesis remains the same. That thesis is intact. That thesis gives you opportunities to take advantage of it every now and then, like we just saw. 3 or 4 weeks of growth kind of stalling on a relative basis. The Q's kind of going sideways. And then it gave you the opportunity. And then the earnings reports from the big four generals gave you your catalyst last week. Speaking of online retail, an oldie but goodie from my first go around with, tech exploding to the upside in the 90s. eBay. Bullish Chaikin power gauge rating here for EBAY, which closed at 56.57 yesterday, up 2.33%. Trend is strong above a rising long-term trend line. And we don't have to talk about the fact that internet retail is a strong industry group. We know it. Interesting here, though. I mean, this is the dynamic in a nutshell, really. You have a strong grower or a growth theme starts to outperform. Trades to a high, just gets a little extended, right? Similar to what we've been talking about with the growth theme in general. Pulls back within the context of an uptrend, becomes oversold, and now we're starting to work out of that oversold position. Overbought, oversold indicator starting to work higher. Money flow bullish. Relative strength is there. eBay is essentially a microcosm of what we were talking about for the past month with the growth over value, the rotation that everybody was calling for that I said just looked like a pause. This is it. Now we trigger a buy signal. Earnings report beat expectations. 4 for 4 on earnings beating expectations over the past 12 months for eBay. That's the setup at the stock level, which is a microcosm for the bigger picture strategic view that we've been carrying. Take a look at eBay here. I like it on the bullish side of the portfolio. I'm featuring it in not 1, but 2 of my notes today. Take a look at eBay as a bullish idea. Let's look at our sector tracker now, moving to the major sectors over the last 5 days. And there they are, folks. Tech and comm services back at the top of the list. All is right in the world. Interestingly, REITs and utilities there as well. Now, if you read my note today, you'll see the bigger picture trend for both of those REITs and utilities is to the downside, right? Utes kind of at an interesting point as it so far tests and holds relative lows going back about 2 years. That's kind of interesting to me, but not enough there to get me excited just yet. REITs, just a steady downtrend. You can draw the channel. We're at the bottom of the channel. Maybe you see a little bit of a rebound in the near term. Maybe that's what this is. Not enough to get me excited. We'll look at REITs a little bit later on in the actually on our next slide. Healthcare, discretionary staples, and fins are higher. Fins, that looks counter trend in nature to me. We'll look at that as well later in the show. And then here's your rotation trade coming off. Industrials, energy. Materials are the ones I like the most, but took us a big hit late last week. So we're going to have to continue to watch that situation as it unfolds. But still, if you're looking for the rotation theme, I think materials are the place to do it. Industry and focus, as I said, REITs over the past 6 months, they have lagged 20%. And the future potential is weak. Look at that ratio. 41-7, bears to bulls. 21 of 21 subsectors. We want to avoid names like SL Green, Kilroy, and National Health, all with very bearish Chaikin power gauge ratings as holdings of an ETF that looks like nothing I want to touch. Very bearish rating. Now the trend is strong because it's above the trend line, but the trend line is declining. So let's use a little common sense here. Underperforming since last November, bearish money flow. It's overbought here in the near term. I'm more inclined to look for short ideas. 41 bearish or very bearish names to look at if you're looking to open to the bearish side. Take a look, do the work. See if it fits your process, see if it fits your time frame. and see if there's an opportunity there for you to potentially make some money on the downside. For me, it's a group we want to avoid right now. I haven't really drilled down hard other than to say I'm just not intrigued by the group. And I'm more inclined to avoid it or look for bearish opportunities. There's nothing here that intrigues me in the least, and especially not their dividends. All right, let's look at what's trending now. Yesterday's movers and shakers, predominantly earnings were leading. Varied, however, is being bought out. MCK beat and raised, takes the stock higher by 6.5%, and then takes its competitor Cardinal Health along for the ride. Jacobs, letter J, up 6% following their print. Dish Network's not earnings related. However, they did select a technology partner that enthused some investors. Under Armour following through to the downside. Carnival talking about increased corona cases as ships have started to sail. That weighs on that stock, as well as Norwegian down at the bottom of the list. CBRE, nothing company specific there, but I just told you what I thought of REITs. Analyst comments, also REITs. Take a look at Host. It's thematic, folks, at this point. As it relates to these coronavirus names, they trade in a group. They trade on the ebb and flow of the virus. You get a negative data point, they get hit. That's what it comes down to. Now, consumer sector trends, and these are both relative. The top chart is discretionary on a relative basis. Now, it's interesting to me because it speaks to kind of risk on or more offensive positioning in the marketplace. XLY topside breakout now pulling back to test that level, right? And that's coincided with our bullish view on the S&P 500, which is now broken topside from a consolidation. You see how we connect the dots there? At the same time, look at Staples, right? Staples are your defensive group, right? Look how well they did when the world was coming to an end, and now it's been a steady decline on the verge of a breakdown. If you're bullish on the equity market, you want to see the Staples continue to lag, and you want to see discretionary rebound here. Now, they both are under near-term pressure. You can see that. But this is a much better trend than this. And sometimes we can look at discretionary relative to Staples, right, and drill down that way. I didn't do that here, but I'm just kind of looking at the sector work for now. But this kind of confirms our bullish view on equities. And to the extent that these trends continue to diverge, this one goes up, this one goes down, it increases the probability of our bullish view on equities. Right, we just kind of update it in real time. But I wanted to show you that because it's a really interesting dynamic playing out as confirmation for the view. But now, bigger picture, we all know that there's a new world order. Just look at the retailers who have filed for bankruptcy over the past few months, right? They all have one thing in common: brick and mortar, late to the game in online. A lot of them. Look at Tailored Brands just went this week. Men's Warehouse, Joseph Banks, things like that. You've probably been on their websites. Maybe you have. It's not the best experience. They missed the boat. Take a look at something like iBuy, though, the Amplify Online Retail ETF. And the only thing that I can say here is that it's extended from its 200-day. Probably it's extended from its 50-day. I'm not calling this out to highlight it that you should buy it now. I'm calling it out because this is a trend that likely has legs, right? This is a bullish fund to Chaikin Analytics, and the trend has legs. Look at it within the context of what's happening, what you're reading about with bankruptcies in the retail space, and you tell me where you think the winners are going to be. Even eBay, which we're highlighting here today. Fund is overbought, but look at the scooter, massive outperformer, type of area you want to be. And then finally, fins are on the floor. XLF probing close to the relative lows against the S&P 500, and that is as the banks remain under pressure. That's going to wrap us up for today. Take us for a test drive, chaikinanalytics.com/test drive to sign up for a free 14-day trial. I'll be back with you tomorrow.